Thanks everybody for having me. My goal today is just to spend some time with you guys and help introduce RTX Ventures to you all, help you understand a little bit more about what we're doing at RTX Ventures. We just started about 3 years ago now, and we're not well advertised among this audience, so I want to just spend some time and make sure you guys understand what we're doing and the kind of innovation that we're supporting. So before I do that, though, I've got to give the RTX advertisement just to make sure everybody's on the same page here. RTX Ventures is a subsidiary of RTX Corporation, the largest aerospace and defense company in the world. You would better know us by our business units: Collins Aerospace, Pratt & Whitney, and Raytheon. About $70 billion in sales, 185,000 employees, 60,000 patents, also about 60,000 engineers, focused on solving the toughest challenges in aerospace and defense, right? Everything from connected aviation to smarter defense systems and transformational technologies in space and elsewhere. And the mission of RTX Ventures is no different, but our tool itself is a little bit different, right? Our tool is to invest in innovation outside the four walls of RTX. And most of RTX's existing corporate tools are more focused on innovation inside the business. So our tool in that way is quite different in that we're focused 100% externally on supporting that innovation outside the four walls of our company. And our business is split roughly 50-50 between commercial aerospace and defense, which means our mandate on the venture side is also split in a similar way between defense and commercial aerospace, which makes us a little bit unique from other corporate venture investors doing things that are similar to us. So I say all that, but what is RTX Ventures? Our mission is to invest in early stage companies aiming to transform aerospace and defense. These are traditional venture-backed businesses. Our tool is not R&D dollars. Our tool is not grants. It is very specifically investing dollars for an equity stake in the business. That means we're looking at companies that are also venture-backed with other investors. For every dollar that we've invested in a startup, it's supported by $16 from other investors. So everything we do is focused on that co-investor model. But beyond the dollars, we also want to make sure that we are connecting the startups that we invest in to all of the resources of RTX. What does that mean? That means connection to engineers you might not know who to talk to about your specific tech area. If you want to know who the best person to talk to is about a specific topic area, you can come to us, and we are the front door to RTX for startups to help you find the right people and engage in ways that might be fruitful for both companies from a partnership perspective or mentorship. Our investments are focused across 6 areas, and really this doesn't quite do it justice. We are focused across our entire portfolio of technologies at RTX, right? That means everything from propulsion to advanced materials, electrification, autonomy, AI, you name it. If it is on a technology roadmap at RTX, it's within our investment mandate at RTX Ventures. So it covers a really broad spectrum. We are only a team of 6 people, so we're talking 6 people as generalists covering all of the technology portfolio of RTX. There's no one right person on the Ventures team to talk to. If your company does materials or space, we all can make sure you're connected across our group to the right folks. So there are, as I'm sure most of you folks are aware, other corporate venture capital arms in our industry, both on the defense side and on the commercial aerospace side. But why are we different? What makes us different? I think the first and foremost, we move fast. What does fast mean? Fast means, in some cases, as little as 3 weeks from an introduction to a company to a check in the door. We're not always moving that fast, but in cases where we're really motivated, we have done that quickly. And that comes from the strong support we have from our executive leadership and from our stakeholders in the engineering department across the company that make sure we get the answers we need to make a decision on venture and startup timelines, not on large corporation timelines. Next piece that makes us unique is that we have a dedicated program portfolio management function. In our first year or two, our portfolio management, meaning how we connect startups to partnership opportunities across the company, was really an email from one of the 6 people on our team and a prayer. And that, as you might imagine, was very ineffective. So in the last year, we've stood up a portfolio development function whose whole task is to make sure we are actively managing and working with our startups and our business units to find ways to work together. That doesn't always happen immediately. An investment from RTX Ventures does not guarantee that there will be a partnership opportunity in the near term. It means that you have an advocate inside the company always to look for those opportunities, and somebody that's project managing, making sure that people are following up on the right timescales to actually develop opportunities and build relationships, versus what I mentioned earlier, an email and a prayer. We are both a financial and a strategic investor. So when people think of RTX Ventures, the first question we generally get asked is, oh, you must be doing this purely for M&A purposes. You might want to buy this company later. What I tell you on that front is, if we over 10 years invest in 100 companies, we might acquire one or two of those. We are not doing this as an M&A precursor strategy. We are both financially motivated, like a traditional financial VC might be, to invest for returns. And we also look for, as I mentioned earlier, ways to partner with the startup. So when we are evaluating opportunities to invest, we are looking at it both from a strategic lens and a financial lens in all cases. And we can invest kind of on both sides of that coin, right? It can be for financial reasons, it can be for strategic reasons. And what we make sure we're doing in every investment is that we're going in eyes wide open and that everybody understands what's motivating a specific investment for us. The last piece here is we're co-investor friendly. Everything we do is focused on supporting other investors in our companies. We know the strength of our portfolio is only as strong as the investors we're investing alongside with. So if we're out here investing in companies that other people don't find investable, we're going to be out of a job pretty quickly because those companies are not going to succeed. I'd leave it there. What are our investment criteria? This is the next question we probably get the most. And for us, everything we do has to be both strategically aligned and, like I mentioned earlier, attractive to other investors. So what does strategically aligned mean? I'd tell you that this box on the left here is probably the easier box to fill, meaning you're developing a technology that aligns to our own priorities at RTX, that there's a way to partner together either now or in the future, or that you're adding some capability that RTX does not have. That one, in general, for the ecosystem that we're in, folks in this room, has been easier to fill. What's harder to fill is finding investments that are attractive to other investors. And we list 10 criteria on the right-hand side of the page here, but it kind of starts with the team, right? Is it a team that's building something? We as a venture investor are focused on investing in sponges, not rocks. We want people that are growing and learning every day, not people that think they have all the answers. We know when we're inventing new technologies and new capabilities, nobody has all the answers. And the next piece of this is really, are you building a product that solves a problem that people are willing to pay for? So there's 10 criteria, but I would kind of summarize it in that way. Are people willing to pay to have the problem fixed that you are developing a product for, versus trying to back solve into the problem that your IP might solve? So generally, if you're building a product that people are willing to pay for because you're solving a problem, investors are going to come. There's going to be a sizable market. There's going to be attractive competitive landscape dynamics. That's all going to come together, but it kind of fundamentally comes down to, are you building something that people are willing to pay money for? The relationships that we developed between the portfolio companies of ours and RTX are obviously mutually beneficial. I think the benefits to startups are pretty obvious, right? You get capital to grow your business. You get access to RTX capabilities, mentorship, co-development opportunities. You get the credibility that comes with the vetting that we put these startups through. Even when we're doing a 3-week process, we're making sure that these companies are in front of the technical experts in our company that are best positioned to help us evaluate what they're building. And in some cases, we're investing in companies that are so early that it's an idea in a garage and less developed product. We really do invest everything from a seed stage idea in a garage to later stage Series E type companies that have material traction. We're stage agnostic in that way. What does RTX get out of it? I mean, I talked a little bit earlier about how we're not doing this as an M&A precursor strategy. We're not doing this to in-house all of a startup's capabilities. We're doing it in a way that's friendly with co-investors, which means we're not putting in onerous hooks. We're not putting in terms that would limit a startup's optionality, which means we're doing it to support innovation outside our four walls, to develop technology that's interesting to us with the support of other investors. And of course, there's the potential for attractive financial returns. We as a group have to pay for ourselves with our financial returns. If we don't, again, I'd be out of a job very quickly. So that's kind of our lens on the world as we look through why we're doing this and what the mutual benefits are. So just a couple pages left here, so I hope people have questions. Generally, this is on an annual basis. We're investing in about 5 to 10 new companies a year. That's coming from 1,000 plus inbounds. We're a small team, as I mentioned, 6 people. So that first high end of the funnel, we're moving through that pretty quickly, whether you're venture backed or not, whether you're the type of business we're interested in, and moving towards these reviews in a quick manner through our funnel. Now, where do we get our inbounds? Where do we get the most interesting ideas? It comes from what's at the bottom left of this page here, right? It's everything from other venture capitalists, other corporate venture capital arms. We do invest alongside our peers. We invest alongside Lockheed Martin Ventures regularly. We're not afraid to do that. Like I mentioned, we are co-investor friendly. If there's mutual interest and we can find a way to do it, we absolutely do. We get it from our advisor network. We get it from the customer network. And we get it unsolicited from LinkedIn, right? We get it all from any channel, and we've got an example in our portfolio of an investment we made in any one of those channels through which an idea has come from, whether it's right from a VC or cold outreach from LinkedIn, right? So generally, we're evaluating 1,000 companies, investing in about 1% of them a year, and to date, we've got a portfolio of about 21 companies. It's the last page in my presentation here, guys, but just wanted to show you quickly what our portfolio looks like today. It's something we're really proud of. 21 companies in about 3 years here. You'll note there's a couple on here that are listed as private. There's no magic or secret sauce there. The press releases haven't gone out, and that's the only reason they're not fully disclosed here for you. But the hope is that we'll find the next portfolio edition here. We're 9 days into the year. We've got to make 5 to 10 new investments, and we've got to move at a pretty fast clip to fill the bucket here this year. So hoping you guys have questions that I can answer for you, and hoping that our next portfolio company might be in the room today. And I see some of our portfolio companies in the room already. So great to see you guys. So happy to take questions for anybody that hasn't. Yeah.
There you go. Mic for you. Excuse me.
Thank you so much. Hi. Thank you so much for the talk. So, quick question. So, for the companies which are in the seed stage, how much of equity dilution and the funding can we expect out of RTX Ventures?
So the question is dilution?
Yes, like the percentage of dilution, and also the funding we can expect, like for the companies that are in the seed stage.
Yeah. So seed stage, across all stages, our check size is generally $2 to $10 million. So we can go below, we can go above, but generally that's what we're looking to deploy in any single investment. Dilution, it depends. It's highly dependent on the startup, right? So, and how much you're raising. So you're going to look at general VC benchmarks for that. In some cases, it can be as high as 50%, and others as low as 20%. So it's a pretty broad spectrum of dilution, if that helps.
And I assume you could have some people from RTX be on the board of advisors as well?
We don't take board seats. We'll take board observer roles. In those cases, we often, if we're leading around, we'll often look for a mutually agreeable independent director that can represent interests of all investors in that round, right? As I mentioned, even for seed stage, we're still looking for other investors to join us. We'll never write a solo check into a round. And we take a board observer role, generally look for a board observer role, and find a mutually agreeable way to represent all investors in the round through a board seat.
Anyone else? Questions?
I have a question less related to, I guess, investor funding from RTX, because I'm from a company that is maybe a little too large at this point to be considered investable. How does RTX invest in technologies that would support some of your investor relations and some of the companies that you have in your portfolio? Do you try to build technologies and capabilities around them?
Sorry, I'm struggling to hear the question.
How does RTX Ventures invest in technologies that maybe in companies that are too large to be a part of, maybe even a third stage investor? I guess my question is, for the companies in your portfolio, do you also look out to find other technologies that will enable them and help them to grow?
Yeah, absolutely. And what I'd say on is your company too big or not, it comes down to valuation expectations and where you think the true potential of the business is, because you could be a late stage company, but if there's an attractive valuation and there's a potential for investors to get 10x their money, then it's still a potentially attractive investment opportunity. So there's a lot of factors that go into, are you too late or are you too big? But then of course, as I mentioned earlier, we are the front door to startups for our company, which means we're going to try to connect you to our own businesses and find out if there's interest there, but also our portfolio companies. So, half of the time, especially like in advanced manufacturing type businesses, our startups are probably on the bleeding edge of testing some of that technology and fielding it themselves. And so we'll go to them and say, like the guy sitting next to Hermias is a great example of those guys are really forward leaning on using startups and new tech to help them with their development processes. And I'll go to them and say, hey, I see you guys have used this tool. What do you think of the tool? Is it something that might be relevant for RTX? Should I invest in it? We try to find mutually beneficial ways to use our total portfolio of both RTX and the startups to find opportunities.
Any other questions? I think we have time for one or two more.
I think you mentioned that your funds are drawn from like your successes. So it seems like you guys are very isolated from management. What do you convey as a success to management for RTX Ventures? Like what counts as a big win?
Yeah, great question. We report out on both sides of the coin I mentioned, on financial returns. So we would report out the same way a financial VC would report out to their LPs. Here's the funds deployed, here's our total fund size, here's our return, here's our paper return, here's our realized return. Same metrics and same benchmarks. We don't separate benchmarks from this is what a corporate VC should expect. We benchmark on the same industry benchmarks that a traditional VC would. And then we also talk about the strategic side. And the way we talk about it is in kind of two different frameworks. On the strategic front is both on kind of big wins. Where are we fielding some potential home run type opportunities? Meaning, a great example is Ursa Majors, one of our portfolio companies. They're in our pipeline as a potential supplier of solid rocket motors. And so that would be a great example. If Ursa Major ends up transitioning to be a solid rocket motor supplier for us, that would be a category of a big potential one. But then we also talk about small stuff, things where we're spending 10, 20, 30K on IRAD dollars to test a product, test somebody's chips, or even in some cases to give them access to our secure facilities, right? So it can range, but what we're trying to do is set up, we have big swings in the portfolio or the stuff like that, and it's developed by some of the smaller stuff, right? It all comes from those initial 10, 20K type opportunities that might grow into a bigger event. And we try to monitor throughout the life cycle of that potential strategic opportunity.
Okay, one more.
Yes.
Anyone else? Over here.
What kind of initiatives do you have on digital engineering and manufacturing?
Say that again, what kind of what?
Initiatives on digital engineering and manufacturing.
Well, we look at all of them. So there's company-wide initiatives around digital engineering, digital thread, new manufacturing techniques. And we try to make sure when we're evaluating startups that we are also taking those to the same groups of people that are managing our own internal RTX initiatives in that same space. Because the last thing, frankly, we want to do is invest in a digital thread company that our research center has no interest in using, right? So everything that we are doing has to tie back to, especially in the cases of engineering tools or advanced manufacturing, at least an indication of interest. If I had to wait for, call it a purchase order from our business units to make an investment in a digital thread company, we'd have one company in our portfolio, total, instead of 21. So we can't wait for a strong yes, but we have to have a strong indication of what they're working on is interesting to me. I could see if it develops in this and this and this way. that I would want to be a customer of that product, and that's how we evaluate them. I hope that helps. Yes.
So, when you invest in such things, how do you deal with IP boundaries? And do you have a bunch of lawyers in your team?
We have no lawyers that are on the team explicitly, but we have our corporate legal team. But what I will say is it goes back to what I mentioned earlier about when we invest, we don't invest with any onerous hooks or terms or things that look like they would limit opportunities for the startup. The commercial agreements and things like what you're mentioning might come through a commercial partnership or a customer agreement. We don't do that as part of our venture investments. That would only come through a customer relationship with our company. When we invest, it is on the same terms that every other investor that's supporting that company is investing in.
Would you be willing to invest in another company that maybe already has a technology relatable to a company you already are supporting?
I would say situational, right?
Okay.
Like we don't want to invest in things that look like direct competitors,
Right.
to existing, where
That
they're
may
going
be
to take away from
complementary.
opportunities. But if it's complementary, or in some cases, like I take advanced compute as a kind of the best example here. There's so many different technologies that they might be focused on a similar set of compute at the edge, but there's a lot of different ways to do it, and we want to support a number of different technologies that are aiming to develop capability in an area where we would take a portfolio approach of
Right.
investment in a space, but certainly not going to try to do anything that's directly competitive with
Okay.
anything in our portfolio.
I'd like to talk.
Yeah, sure.